So as you see now we are going to do a super quick revision on section number 10 AA, a 5 marks area. Okay, 5 minutes we are going to complete for 5 marks. Special provisions for newly established units in says. So first one, applicability. Manufacturing undertaking. Okay, manufacturing undertaking. Manufacturing of what? Product, article or thing or computer software. So it can be PATSI. Means what? A product, article, thing or a computer software that should be manufactured by an undertaking located in SS. Applicability over. How much will be deduction if I do? Okay, your normal profit I will not give any deduction. First 5 assessment years, 100% of your export profit will be allowed as a deduction. Next 5 assessment years, 50% of the export profit will be allowed as a deduction from the total income. After that, next 5 means what? 10 to 15 years. 5 years means 10 years over. 10 to 15 years, how much amount will be allowed as a deduction? Amount credited to a reserve called as the cess RERA account. Says reinvestment reserve account. Says reinvestment reserve account. To that account, you need to credit an amount. Okay, or 50% of the export profit, whichever is lower, will be allowed as a deduction. Very, very important. What are the allowed as deduction? First 5 assessment years, 100% export profit. Okay, next 6 to 10, 50% of export profit is allowed as a deduction. Next, for the next 5 assessment years, until 10 to 15, it will be allowed as a deduction. How much amount? Amount credited to Cesar account or 50% of export profit, whichever is lower. So, what is an export profit? Export profit. Export profit means profit of the unit located in the CES. See here, profit of the unit located in the CES, total profit, export and domestic, total profit of the unit located in the CES into export turnover divided by total turnover. Okay, what is export turnover? That much of export turnover which you brought into India. Just making sale outside India is not important. That amount should come to India within 6 months from the end of previous year or time permitted by RBI. Okay, and that amount, whatever the export is there, that should be created in a separate bank account in India. Okay, so tell me, what is export profit? Export profit means total profit made by, as per PGBP, we need to compute total profit of that says unit into export turnover divided by total turnover. Export turnover means export amounts which are brought into India within 6 months from the end of the previous year or permitted by RBI, the time permitted. Next, in that export turnover, what should not be included? Any freight collected? No. Any telecommunication charges or insurance charges or any export for providing expenses for providing any service, incidental charges if you collect from them. So, freight charges, telecommunication, insurance, or any other incidental charges you collect from them, that should not be treated as a turnover. Those comes under other incomes, not under export turnover income. Okay. Okay. Next one. Deduction will be under cash compensatory support. Any cash compensatory support or duty drawback or profit on sale of import licenses. These three should not be included into total turnover because these three, especially cash compensatory support, duty drawback, and profit, should be treated as business income under the head PGBP separately. Charging section, it will be there already. So these incomes should not be included into export turnover. Next one. You are starting a manufacturing unit now. For that, you have to use a plant and machinery. Yeah, that plant and machinery should be a new plant and machinery. For that, there is an exception. Already depreciation, the same exception will come. Additional depreciation. 20% of total value of plant and machinery can be second hand. Okay, and plant and machinery imported to India, already used outside India. Now you imported to India. Yes, you imported. Now, if you import it to India for the first time, then deemed as a new plant and machinery only. Next one. Section 10AA deduction is not available if you go for alternate tax regime. Next, 10AA deduction is available after claiming deductions under Section 80. Means though Section 10 comes before Section 80, claim all deductions under Section 80 available for you, and then you claim deduction under Section 10AA. Next one, amount credited into the cess RERA account for this last one. Okay, amount credited into cess RERA account should be utilized to acquire a plant and machinery within a period of 3 years. You should not just acquire, you should acquire and you need to put to use within 3 years from the end of the previous year in which a reserve is created. If not, after completion of the 3 years, it will be treated as a business income. Okay, so this is all about the concept of Section 10AA. To sum up everything,